Well, the big breakout in the banks, both big and small, since the election has put the financial sector in its most overbought condition in nearly 30 years, at least according to Bespoke Investment Group. So the question is, will the rally continue or will it promptly sell off? Here now to talk about it are Max Wolff of 55 Capital and Boris Schlossberg of BK Asset Management. Max, and that's, listen, Bespoke does great work. Paul Hickey and his team, well known to CNBC viewers. That's their call technically. Do you agree?
Yeah, so for our perspective, fundamentally, what we think has happened here in this space is there's a giant buying of all that risk we sold off during the unusual 9-day run there when we saw everybody trying to get away from risk assets ahead of the election. We think people have decided the worst is behind us. We hope it's true. We don't see any evidence. The risk to us wasn't the marriage, wasn't it wasn't the wedding, which is what happened on the election day. It's the marriage, 4 years, hasn't started yet. But we do think the generally less intense regulatory environment will be good for these companies. But we would caution people, less regulation usually means even less consumer confidence. And even though it's hard to imagine the public having less love for the banks, we're afraid less regulation might bring that, because a lot of folks did vote for the president-elect Donald Trump in part because they felt like Hillary Clinton was too close to the financial institutions. Yeah. So we're not so sure that the best laid plans of massive deregulation are going to come through the Congress unscathed.
Which is just some alternate. It's so weird sometimes to hear that Trump was the non-Wall Street candidate. Getting away from politics, though, Boris. But there's an element. Yeah. I hear what Max is saying, and I don't disagree. But there's an element too of just good old-fashioned. Are the banks going to make more money? Interest rates, they've needed them to go up. They're going to go up. You got to get to know NIM, NIM, net interest margin. It's a little basic thing, but basically, you think they're just going to, part of this is just them making more money? A little bit more in what they loan?
No, absolutely. We've been talking ad infinitum about the fact of the steepening yield curve, and now we're starting to see that happen. So there's no doubt that this is going to be much more profitable for the banks going forward. Also, whenever somebody says to me something is at a 30-year overbought condition, my first instinct is not to fade the move, but actually buy the dip, because that means we're in a breakout territory. That means there's a seminal, tectonic, massive shift here, and I think the banks are going to be a buy the dip buy for quite a long time.
Define long time. Because in this day and age, it could be 7 minutes.
Yeah, exactly, 7 minutes. But I would say I think they're in a sort of a benign cycle for at least 12 to 18 months forward, because interest rates are, in my opinion, incontrovertibly going up, and that should really help them on the P&L basis.
All right. Interesting discussion on a group that perhaps has gotten more focus in 5 days than in the previous 5 or 6 months combined, and for good reason. A lot of these banks are up 20 and 30%. Boris, Max, thank you both very much. Folks, thank you for tuning in to Trading Nation. Brian Sullivan, we'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.